welcome. You're watching the Mutual Fund Show. I'm Tamanna Inamdar. This is your one-stop destination for all things mutual funds and your investments. Now, today we're talking about the Nifty 500 Index Fund. If you want to bet on the Indian equity market as a whole, you can go no further than the Nifty 500 Index Fund. It's a fund which mirrors the Nifty 500, which is an index which has the top 500 companies on the Nifty. So the most comprehensive market index in India, undoubtedly. So it covers 500 of the top companies across large, mid and small cap. They offer a broad diversification and exposure to nearly 92% of the market cap of the NSE. There's been a recent launch also of an NFO on the Nifty 500 Index Fund, so there are a lot of products out there as well. The question we're going to be tackling today is this the right choice for your portfolio? If you're looking for an index fund, don't want to restrict yourself to the top 50 stocks on the Nifty, and don't want too much of a downside risk either. Are the potential returns worth the risk? To talk on this, I'm joined today by Pankaj Matpal, founder and CEO of Optima Money Managers, and Rin Agarwal, financial educator and founder at FinSafe India. Welcome to both of you, and thank you so much for joining us. Great to speak with you as always on this show. Pankaj, let me begin with you in terms of returns. What are the kind of returns that such index funds, ones that essentially mirror the Nifty 500, what are the kind of returns they give?
Tamanna, good afternoon. See, Nifty 500, because it represents 500 companies listed in the equity market in an NSE. So you are investing in large cap, mid cap, small cap. If you see long term, you can expect around 15% CAGR from this kind of index. And but one has to understand, because your investment is across the market segment, across large cap, mid cap, and small cap, so your investment horizon should be longer.
In fact, you know what, let's look at the one-year returns of some of these top funds before we move ahead, and just put into perspective exactly what we're talking about when we talk about the Nifty 500 funds. So this is the average one-year return and three-year returns, because some of these funds have not been around for 3 years. These are the top ones. So the MOSL Nifty 500 over a year has given 35% returns. In 3 years, it's a bit more tempered. 16.5%, nearly 17%. The ICICI BSE 500 ETF has given a 36% return on average, and 18% return in the last 3 years. The HDFC BSE 500 ETF has given a 36% return. Obviously, they're all mirroring the index, so the one-year return is pretty much the same. So an average of 36% is what you are getting, and it mirrors what happens out there. Now, Rin, if you look at it, it's not. It's a pretty decent return, since it's a passive fund, lower costs. Is this a good choice for someone who's looking to put in money and doesn't want to think about it too much?
So good afternoon, Tamanna, and lovely to be here on the show as always. Well, I would say that it really, the choice of investing in this fund really depends upon what is your existing portfolio, because when you look at the NSE 500 index, the top 50 stocks, which is the Nifty 50 stocks, have a 60% weightage in this particular index. And if you look at the Nifty 100 stocks, they actually have a 73% weightage. So in effect, this index is quite top heavy and large cap oriented. And if you see the balance, 400 stocks are from the mid cap and the small cap space, and that is around 27%. So, while it does give you access to the broader markets, we must remember that given the fact that the index is constructed based on free float market capitalization, it does tend to have a very high exposure to large cap stocks. And so, in effect, what I would say is that if you already are having Nifty 50 index fund in the portfolio and you're going to add this on, there would be a very high overlap on the stocks that you're actually holding between these funds. So in those cases, I wouldn't actually recommend it. for someone who's new into the market, who wants to take exposure to the broader markets, they could look at it.
Okay. So what kind of, let me come to you on that question, Pankaj. What kind of an investor should be looking at these funds? And there's a new NFO on the block also. Is there an option one should be looking at?
See, Tamanna, first thing, as you mentioned, as you showed the graphics, like in last 1 year, Nifty 500 delivered around 34%, 35% returns. But investors should not go with the 1 year return. See, when you are expecting long term or when you're investing for long term, that 15% around CAGR, what I mentioned, is the right expectation. Second thing, who should invest? See, if you want to invest in multi-cap funds, then this is a good choice because it covers large cap, mid cap, small cap, everything. So that is why if your objective is to invest in multi-cap fund where you want to have allocation across the market segment, across the sectors, then it is a good choice. But if you want to invest for a shorter term for a large cap bet you want to take, then I think that Nifty 50 or Nifty 100 fund can be a better choice. So investors who have investment horizon for more than 7 years want to take the exposure across the market segment, who have moderate to high risk appetite, they should consider investing in Nifty 500 index fund.
Okay, so moderate risk appetite is what you need to do. Now, among these, Marin, and that's where the question gets a little tougher, among the current options, if someone is looking for this kind of a fund, which one do you prefer? Or does it not matter? Because at the end of the day, they're just mirroring the index performance. But having said that, what is a fund that you would recommend someone to take up if they're looking for such a broad market exposure, and what proportion of your entire investment should go into a fund like this?
So Tamanna, I would again reiterate that, if you're already holding a Nifty 50 index fund, by investing into this fund, you're really not getting further diversification. Also, when you look at the rolling returns, which are a better way to look at returns as well, more realistically, if you look at the rolling returns, there is not much difference in the rolling returns between the Nifty 50 TRI and the Nifty 500 TRI as well, right? So again, what I would say is that if you're already holding a Nifty 50 index fund, I wouldn't actually recommend a further investment into the Nifty 500. I would rather say that if you really want the diversification, then go in for Nifty Mid Cap 150 or maybe a Nifty Small Cap 250 index. That would give you better diversification. Now, if you are not holding a Nifty 50 index fund, and you want to look at a broad-based funds, I would always look at an existing fund which has track record, whose tracking error is also known. So I would say then look at the Motilal Oswal fund.
Okay. So Motilal Oswal fund is a choice. Pankaj, I'm going to come to you on that question as well. Which fund of all relatively better, and percentage of allocation, or you would say avoid completely?
No, I would not suggest anybody to avoid it. One can definitely invest in Nifty 500 fund, because if the objective is to create wealth in long term, and you want to, for example, you want to start SIP where you have only 1 or 2 funds in your portfolio. So this kind of fund can be a good choice. Yes, as far as name is concerned, Motilal Oswal Nifty 500 is a good choice because of low tracking error, low expense ratio, and with a performance history. But as a segment, as a category, I will not rule out that one should not invest in Nifty 500. In your portfolio, definitely you want a diversification, and you have a choice. Either you invest in one large cap, one mid cap, one small cap, or through one fund, you can get exposure across the market segment.
Yeah, okay. So that is the upside of it. Through one fund, you can get the entire market exposure as well. And returns are not half bad. You don't have to think about it too much. On the downside, maybe you restrict your options as well. All right, let's come to some of your queries. Manish Prajapati writes in to us. And remember, if you want to get our experts to answer your questions, those numbers on your screen. Manish Prajapati is age 37, says he is looking to invest 1 crore rupees with a 15-year time horizon. Says my goal is to reach 5 crores. I'm looking at an SIP of 1 lakh per month and to do a lump sum when the opportunity comes. I'm willing to take a moderate risk. What are your suggestions? Well, interesting question there, because the number is not insignificant, 1 crore rupees, 15-year time horizon, and in 15 years he wants 1 crore to go to 5 crores. So Pankaj, let me start with you and with that basic question. The time horizon and the ambition, are they matching?
Exactly, Tamanna. If even I calculate at a CAGR of 12%, 1 crore rupees invested today will grow to around 4.78 in 15 years. So close to his target, what he's expecting.
Okay.
So that is quite.
So not an unrealistic target. Target is fair. He might even exceed it.
Exactly. And he says that he will invest 1 lakh rupee per month along with that. So he can expect around 10 crore rupees in 15 years with this investment. So the target is quite means reasonable. And if I recommend some schemes for 15 years, he can consider like Kotak Multi-Cap Fund, ICICI Prudential Multi-Asset Fund, Bajaj Finserv Flexi Cap Fund, and Motilal Oswal Large and Mid Cap Fund. So all diversified funds for 15 years time horizon.
Okay. So those are some of those picks that you have. And you know, the second part of it, Mrin, I'm going to come to you on the second part of it, and of course you can address the basic question as well. He says, I'm looking to invest a lump sum when the opportunity comes. Now here is where the devil lies in the details, because how do you know the opportunity has come? I think that's the million-dollar question, isn't it?
Absolutely, and I think I think this is what happens when you have a bull market for 4 years, that overconfidence creeps in, and we feel that that we can spot these opportunities. Honestly, it's very difficult, and I would just say that set up a SIP, right, and of course keep some money aside if you feel and as and when, if you feel when there is a correction and you feel it's a good time, you can look at putting in some money. But I would say that for a majority of the money, set up the SIP and just get going with that.
Okay, so keep it as an SIP. That is safer, definitely. Pankaj, I'm going to ask you that question because I know you face it many times. When is the right time? And before and after every big event, I mean, we have a big event coming up in terms of the Fed rate cut. It's likely to start off a cycle of rate cuts. Everyone's going to be wondering what to do next. Is this the right time is a question you will ask. How do you know? And especially for this viewer who's written in who says they are willing to take moderate risks.
Tamanna, it's very difficult to time the market, and that is why SIP helps in averaging out your cost. That's a better choice. But yes, as you mentioned, sometime when we feel that because of some event, for example, before election, like we were expecting that time that if the result will be what kind of result we were expecting and what would be the impact of that. So if that kind of some events are expected, something or like Fed rate cut right now, based on that, you can definitely increase or decrease your exposure. But otherwise, very difficult to time the market. My suggestion for retail investors that they should invest in staggered manner. SIP, STP is a good choice for that.
Okay, SIP and STP is a good choice. Better to have it in a staggered manner, especially since your investment amount and your timeline is not unrealistic. So you don't have to do anything out of the box. Stick to the straight and simple and you'll get there. Sandeep is joining in, age 58, says, which is the best balanced advantage fund to invest in for the next 5 years? Sandeep, thank you so much for writing into the question. Mrin, I'll start with you. Why don't you start by giving our viewers a sense of why a balanced advantage fund, what is a balanced advantage fund, and what are the pros and cons?
Balanced advantage funds are investments where they invest both in stocks and in bonds. So they have both equities and debt in the portfolio. Now, the percentage allocation between stocks and bonds is going to differ based on an internal metrics created by the fund house. So it could be on PE ratio, it could be any quantitative metrics that has been developed by the fund house. So based on that, they vary the allocation between equity and. So the good thing is that what happens with balanced advantage fund is that they do the rebalancing for you within the fund, and it is not something that you have to do. So, like for example, you have the ICICI Balanced Advantage Fund, wherein when the markets are at a high, then they will automatically reduce the allocation to equity and move into debt and vice versa. And of course, this is done at regular intervals. You also have other funds which, for example, might follow a momentum strategy, like, for example, Edelweiss. So each fund in the category actually has a different set of quantitative parameters based on which they do the rebalancing. But net for the investor, it's a great investment because in this one fund, you can get your asset allocation done in debt and equity, and the rebalancing is also happening automatically. So from a moderate investment perspective, this is highly recommended. And again, you choose the fund based on the sort of risk that you would want to take. My recommendation would be the ICICI Balanced Advantage Fund.
Okay, so ICICI Balanced Advantage Fund is something you could look at for the next 5 years. Pankaj, I'll take that question to you. 5-year timeline is good enough for a balanced advantage fund?
A hybrid fund which invests in equity and debt both. So 5-year investment horizon is a good time to invest in. But one thing I would like to mention here, see, balanced advantage funds are basically dynamic asset allocation fund which invest in equity and debt based on the market that allocation is changed by the fund managers. But some funds are like pro-cyclical, some are counter-cyclical. That is why all the balanced advantage funds are not following the same model. So if you want a scheme where you want that aggressive allocation in equity, then Edelweiss Balanced Advantage Fund or HDFC Balanced Advantage Fund can be a choice. But otherwise, if you want more downside to be protected, then ICICI Prudential Balanced Advantage Fund can be a better choice.
Okay, let's go on to the question. Rahul has sent us, age 37. He's looking to invest 20 lakh with a 7-year time horizon. Needs lump sum investment advice. So let's start with the basics. First of all, if you're looking to invest 20 lakhs with a 7-year time horizon, Pankaj Matpal, I'll come to you. Should this investment be done in a lump sum?
Yeah, exactly. See, when you say lump sum, does not mean that in a single day you have to invest the whole amount. You can divide it in 4 or 5 parts, or maybe that 6 installments. So you do STP of 6 weeks, something like this one can invest. But I would not suggest that somebody invest that money in 6 months or longer period when the money is already available, because sometimes that you keep buying at the higher rate. So either you divide in 4 parts, 5 parts and invest on your own, or you start STP of a weekly STP of 6 weeks, something like that, so that in 1.5 months, you invest that total money. So that is a suggestion from my side.
What are the kind of funds he should put this in? So,
yeah, because
so
7
first
years.
You're saying not lump sum, and then you're saying look at STP, etc. So over 7 years, what is the kind of breakup that should be done for a 20 lakh amount?
Yeah, see, 7 years is a good time period as such, means he can take some risk. And in this case, I'll suggest that a scheme like Flexi Cap, Bajaj Finserv Flexi Cap Fund can be one choice, or Motilal Oswal Large and Mid Cap Fund. So not a pure small cap fund, I would recommend to him, but some diversified funds which invest majorly in large cap and mid cap, that kind of funds can be considered.
Okay, let me come to you, Mrin, with that question. Suppose there is a requirement to do a lump sum investment for whatever reason. What should that breakup look like? And if there's a choice, go for an STP or an SIP?
I agree with Pankaj that he should consider doing an STP and not wait too long to deploy the funds. Also, in terms of the fund choices, I would go in for more conservative funds over mid cap and small cap funds. And I would suggest Nifty 50 index fund like ICICI or UTI. And he can also consider some Flexi Cap funds like Parag Parikh Flexi Cap Fund and HDFC Flexi Cap Fund.
Okay, so Flexi Cap Fund seems to be the choice that both our advisors are talking about. Let's look at the question coming in from Natarajan Ramanathan, aged 55, says, I'm looking to invest 10,000 rupees a month for over 7 years. I can't choose between the UTI Nifty 50 Index Fund and the ICICI Pru Nifty 50 Index Fund. Which one should I go for? First of all, let's start with the basics. Our viewer, for age 55, Mrin, I'll come to you first, says that they want to invest 10,000 rupees a month for the next 7 years. Is an index fund and a Nifty 50 index fund the best choice? Let's start with that first and then come to which one.
I think it's a good choice, especially given his age. I think it's a good choice. And Tamanna, for a lot of investors, it becomes very difficult to figure out which fund to invest into. So by investing in a Nifty 50 index fund, you're really participating in the India story. And in that sense, I think it's a good fund. Now, between both the funds, honestly, again, when one looks at the rolling returns, there is not that much of difference in the returns. Of course, UTI does have a slightly lower tracking error. I think it was 0.04 in the last 1 year versus ICICI having 0.06. So you could go in for either of them because tracking error at the end of the day is the main thing to look at in the index fund. That said, UTI is lower in tracking error, but if you look at the returns, they're pretty similar. So he can make his choice based on this.
Okay, so, Pankaj, does it really matter if it's an index fund after all? It's not like the fund manager has to do much.
See, there's a difference between tracking error and expense ratio, or because of expense ratio and some more things that tracking error is different between different funds. So here, as Mrinal explained just now, so difference is not much. If you say last 1 year, even the tracking error is not much. I mean, there is no much difference between two funds. He can choose any one of them.
Okay. In your view, Pankaj, is an index fund, a Nifty 50 index fund, a better idea? And let me hark back to a question which is the topic of the show today. If I have to choose between a Nifty 50 index fund and an NSE 500 index fund, which one would be preferable?
See, it depends that your risk appetite, your objective investment, your investment horizon, especially for this viewer, Natarajan, because he had mentioned that his investment horizon is 7 years, his age is 55 years. So considering these, this information, my suggestion would be that Nifty 50 will be a good choice. But if a young investor wants to invest for longer duration, in that case, even mid-cap, small cap, or if somebody wants to invest in a multi-cap, then Nifty 500 can be a better choice. So it's not that each fund will be for every investor. One has to see that what is the objective and how much risk one can take. As I mentioned, for Natarajan, this is a good choice. Otherwise, Nifty 500 can also be considered. And beyond that, there are many factor investing fund, smart beta fund. Those make better choice for many investors.
Okay. Joe's writes in to us, age 53, says, I want to invest 70 lakh rupees on a Flexi Cap Fund. Which one should I go for? Great question, Joe, and thank you so much for writing in to us. So, Pankaj, here, they've not mentioned whether they want to go lump sum or, STP or SIP, but assuming the age, you'd probably not do too long of an SIP or an STP, and the amount is also significant. First of all, if there's 70 lakhs to invest, should it be in one go, and how much of it should then go in a Flexi Cap Fund?
See, again, because information is not complete here, if the investment horizon is something like 7 years or more than that, then Flexi Cap Fund can be considered along with some multi-asset allocation fund. But Flexi Cap is a good choice because it gives you opportunity to invest across the market segments. At the same time, fund managers have flexibility to decide that where they want to have major allocation of the total asset. So Nippon India Flexi Cap Fund, Bajaj Finserv Flexi Cap Fund, or ICICI Prudential Flexi Cap Fund, these kind of Flexi Cap funds can be considered. And if I want to add something more to this, like as I mentioned, multi-asset allocation. So ICICI Prudential Multi-Asset Allocation Fund is a good choice, which gives you a choice to invest across the asset classes like equity, debt, gold, etc.
And which is the best Flexi Cap Fund in your view?
Yeah, like Nippon India Flexi Cap Fund or Bajaj Finserv Flexi Cap Fund, ICICI Prudential Flexi Cap Fund, these can be considered.
Mrin, what about the Flexi Cap funds of your choice? Because that's essentially his question. which one should I go for in terms of a Flexi Cap fund?
Well, I like Parakparik Flexi Cap. I think, the international exposure is an added advantage in that fund. And I like the HDFC Flexi Cap, good fund for long-term holding, has worked out over long periods of time. So these are my two choices.
Okay. So Sheel is joining us, and I think I'll just be able to squeeze in one more question. He's 24, started investing 4,000 rupees each in the Parag Parikh Flexi Cap Fund, something Bryn just mentioned, and the HDFC Nifty 50 Index Fund this month. He's also planning to invest in mid and small cap funds. He's seeking some recommendations. Yes, Bryn?
So if you're looking at mid and small cap funds, I like Mirae Mid Cap and I like SBI or Nippon Small Cap. He could look at either of these. And actually, I would say that if his horizon is long term, then look at the small cap funds, because the actively managed small cap funds, there are quite a few funds which have consistently beaten the benchmarks very well. So I would actually suggest more on the small cap side, considering that he already has the Nifty 50 Index Fund and the Parag Parikh Flexi Cap Fund.
All right, thank you so much, Mrin and Pankaj, for joining us today, and for all our viewers also who have tuned in and sent us your questions. In fact, if you want to write in to us, the number is on your screen. We're happy to take your questions and have our experts answer it. But for now, that's all the time we have on the show. Stay tuned for a lot more to NDTV Profit.